the Gould Mine podcast.
Yeah, so I mean, and it sounds like a lot of educated discernment. I halfway expected you, Dan, just in getting to know you this last 40, 45 minutes. I have expected you to whip out this fancy equation. This is my risk. This is my risk equation. But it's good to hear that you and I kind of think about it in the same way, which is hey, we have these return buckets, right? It's almost this is the return I'm looking for this type of project. If the project needs this, and this, right, then that means there's elevated risk, which means that the returns need to be this much higher. Because you're right, at a certain point, you've seen enough deals to know, hey, this one's like a slam dunk. It's not gonna give me these amazing returns, but very few things could go wrong. Versus hey, we've got the renovation, if we're doing one right now, our hotel deal, which is definitely, it's riskier project, but tremendous upside. But yeah, the renovation, the CapEx is actually going to be more than the acquisition, right? And so you got that, and so there's a lot of things there that kind of make it impossible to invest in unless you have a really, really juicy projected return, because otherwise the deal just doesn't make sense, right? To kind of risk that money. So I hear what you're saying, and that makes a lot of sense. And I think everyone back at home, and maybe for you, Dan, how did you go about kind of determining those return buckets, if you will, right? And maybe buckets isn't the right word, but it's the spread. So hey, from a 12 to 16, I'm good with this kind of asset, and from 16 to 20 or from 20 to 24, is that just having seen hundreds now probably of deals? Is that through the experience as an LP? How did you start to kind of quantify the risk in a way that made sense for you and for your risk profile?
Yeah, I think for a while it was more of the gut feel in my head kind of a thing. But then recently I saw it laid out this way. I can't honestly remember where it was an article or was an industry type publication that kind of had a graph going up and to the right. And it had these kind of tranches of expected return and risk, right? And so it kind of just crystallized when I saw that. It was okay, other people have, probably spent a lot more time at it than I have, and maybe try to quantify it and so forth. But what I was telling you was roughly on there, right? So you got the plug and play core plus, less risky. If that's much lower expected return, maybe 12, 13% IRR, and then right in the middle is maybe some light value add, 15, 16%. And these are right now. Again, 2 years ago, these numbers could have been different, right? It was a different ballgame when interest rates were lower, but development, you got to have a lot higher expected return because there's a lot more risk. And I, again, invested in enough projects. I was able to kind of see some of this play out, right? Where I had projects that there was a little bit more risk involved. Maybe things didn't go as planned quite as often as the more predictable ones. So, you have a theory, and then you see it play out, and then you see industry publications. I think it all just kind of came together for me that, you really have to look at these things. And 5, 6 years ago, when I first started investing as an LP, I probably wouldn't have thought about it quite like this because I didn't have the level of experience, right, that I now have.
Mm-hmm.
So I would have been a lot more naive about, what the expected returns and how they correlate with risk. I wouldn't have been thinking as much about that. But now I think a lot more about it. And especially now, again, because it's gotten a lot tougher in real estate, in the last couple of years as interest rates have risen. For a while, it was, you could almost, people were buying anything and flipping it in 2 or 3 years and just seeing a big exit profit because everything was going up and to the right. When things aren't going up and to the right, the amount of risk in a project is much more important because those are the ones that you could lose capital on, or they could just, the bank could take it back. Some of the things you're reading about in the news, right? And another risk factor is fixed rate debt. So we've typically gotten fixed rate on all our stuff. Not that there's anything wrong with variable debt, but a lot of people got in trouble with that in the last couple of years. And so the biggest distressed projects are generally, a lot of them are a result of variable rate debt and bridge debt and so forth. So that's just another checkbox, right? If you're getting involved in a project, fixed debt, it doesn't matter what the capital markets do over the next few years, you're still going to have the same debt service. So that's just another element of risk too, is the debt structure, the capital structure. So
yeah, and I think that just comes back down to investment thesis, right? Because a lot of as you mentioned, right, a lot of the variable rate debt right now is really being given out to the value add kind of projects where,
that's right.
You're not getting a CMBS on
Yes.
or any sort of fixed rate product on something that needs a bunch of work done, because, well, first of all, it doesn't make sense for the bank, and second of all, it doesn't really make sense for the project. Like, no one really wins. That's interesting, man. Well, look, we're running up on time. Definitely want to be respectful of it. That actually it's a great transition though, because you talked about debt and just current market right now. The last couple questions here for you. The first one being, looking at where the market is right now, how are you navigating the current challenges that the market is presenting, and how do you see this market? Like, how do you see the market changing or evolving in like the next 6 to 12 months, if at all?
Yeah, and no question, it's been difficult to find acquisitions that make sense in the last year or two. I mean, I saw a recent graph that multifamily transactions are down over 75% last year and this year from 2022. Of course, that was kind of the peak of activity, right? So a lot of deals aren't getting done. So again, part of this is patience. I mean, myself and my partners, we don't care as much about getting a lot of deals done. We want to make sure they're deals that make sense. So we've said no to a lot of deals. We're realistic. We're not just trying to build up assets under management or something if the market doesn't support that. So we're able to be patient. We'd rather, sometimes they say the best project is one you didn't get involved in, right? So we're thankful probably we didn't buy a couple of things we were looking at a year and a half ago, right? That we almost maybe pulled the trigger on. So I think patience and being disciplined. And but there's some off-market opportunities. So the last couple of deals we've done are off-market. A lot of this deals for brokers haven't made sense, right? There's just still kind of a gap between seller expectation. They'd still like to sell at a price close to what they could have 2 years ago.
Yeah.
But let's face it, those prices have come down on the order, 20, 25% on average, in some markets more. So, and buyers, we can't pay that price with the current interest rates. So there's kind of still a gap. I think it's starting to lessen. Some people think there'll be some distressed assets that get flushed out, but we'll see, right? I think we're just always have our ears to the ground, looking at what's out there. We're still touring properties. We're still looking at stuff. Again, a couple of last deals we did were development, so somebody didn't have to sell. These are just newly developed. So if we can find opportunistic projects like that, we'll continue to look at those, right? Because builders still want to build. If they've got a staff of people, maybe the market's not great, but they still want to build. And if we can get in at a good cost basis, we'll look at that. So we're still looking at and trying to execute on opportunities, but we're willing to be patient and make sure that they pencil out to adequate returns based on the risk return profile we talked about, right?